So for the next gold rush, would you rather be a gold prospector looking for and mining gold, the guy who sold the prospector a shovel, or the guy who provided cash to the prospector to buy the shovel in exchange for a percentage of all the gold he ever finds? Welcome to Silver Heist. Thank you to our returning subscribers and guests. We are a channel that likes to hold physical gold and silver. To support my creation, please subscribe. I'm pleased today to be joined by Mr. David Garofalo. He is the president, CEO, and chairman of Gold Royalty Corporation. I'd like to thank Gold Royalty Corporation for sponsoring this interview and making the leader available today. Mr. Garofalo, thank you and welcome to the show.
Thanks, Rob. Nice to see you.
How long have you been interested in gold, and what is some of your background with respect to gold?
Well, I've been in the mining business for over 30 years, and I've spent equal amounts of my time in both the base and precious metal side. Been involved in the development of 15 mines across the world, both on the copper and gold side. So even though I'm a financial guy by background, I'm a CPA by training. I actually learned the business from the ground up right out of accounting, and been involved in all those development stage assets, and I've operated countless other mines over the course of my career. And so I really come at it from an operating perspective, and that's kind of my mindset, even though I'm running a royalty vehicle today.
So there's been a lot of money printing going on. Are you concerned about our futures?
Yeah, look, I think it's not concern, it's just an observation. There's been a tremendous amount of quantitative easing going on, and what that means really is printing a fiat currency. And it's a competitive debasement of currencies that's going on around the world to preserve export markets. So if one central bank does it, the other central banks are going to do it so that their economies remain intact and competitive. But ultimately, that's going to have consequences in terms of inflation. And we're seeing that the headline numbers may be alarming to some people, at 5, 6, 7%, whatever they are, but they actually vastly understate what real inflation is. If you bought a house, if you put fuel in your car, if you heat your home, if you buy food, you're paying double-digit inflation. I defy anybody to say otherwise. If you've gone to the grocery store and paid for all these things, you can see it in the cost of living. It's gone up dramatically. And these CPI numbers tend to have baskets that exclude all the things that we actually fundamentally need as humans, which is kind of pointless. The reality is we have inflation. And what that means is with interest rates effectively at zero on a nominal basis and negative on a real basis, your capital is getting eaten away every day by inflation if it's sitting in a bank account. And to preserve your capital, you have to look for a currency that can't be printed. And that's why I've always had an interest in gold, because of its scarcity, because of its indestructibility, and because of its recognition as the ultimate currency for 4 millennia.
How do you see the demand for gold by governments and or central banks now and going forward?
Well, actually, it's been relentlessly positive for the last decade or so, really since, the credit crisis back in 2009. When there was a coordinated effort by the central banks globally to stimulate the economy, in other words, dump money from helicopters, the central banks, recognizing that the fiat currencies were being debased and interest rates were effectively zero, said, well, there's no opportunity cost to owning gold anymore. Back in the late 90s, when gold was $250 an ounce and treasuries, you were yielding 7 or 8%. Of course, you sold your gold and you bought treasuries, so you got yield. Today, you don't get yield. In fact, that capital, that principle is being eroded every day by inflation. Central banks are no different than people. They're run by people, and they recognize when those reserve currencies are being debased, they want to hold on to something that can't be debased. It can't be printed. In fact, gold supply is going down in the face of higher gold prices because of the difficulty of finding these deposits and also building them out. Capital intensity, the barriers to entry extremely high from a social and financial standpoint. So it's not like we can flick a switch in the mining business and suddenly flood the market with more gold because the gold price is high. It's quite the opposite. And that's really what underlies the value proposition, the security proposition that gold provides.
What direction is the demand for gold moving, and what direction is the supply moving?
Well, look, it's the same dynamic on the demand side outside of central bank demand. People are buying gold to preserve capital, to protect their savings. Many of the smartest investors are typically allocating 20 to 30% of their portfolio to gold for that very reason. I think they're concerned about equity valuations and how they're being stretched. Jewelry demand is still strong. It's always there. It's cultural. Look at places like India. China, for example, is the biggest producer of gold in the world, but is also the biggest consumer of gold in the world, actually consumes more than they produce. So all of their gold stays onshore, and that's both at the central bank level, but at the individual level, because they're concerned about the preservation of their capital in the face of relentless printing of their currency. The supply dynamic, and I alluded to this a little bit earlier on, we actually haven't seen an increase in mine supply. Just to give you a sense, volume-wise, what we're talking about in terms of the size of the gold market, there's 200,000 metric tons of gold on the Earth's surface have been mined since the beginning of time. And volumetrically, to give you a sense of what that means, it's about 4 Olympic-sized swimming pools. It's tiny. It's a tiny volume, and not a lot. It's very difficult to find the gold and to produce it. As an industry, we produce about 4,000 metric tons per year. So we add about 5% to supply. But that's going down because over the last half a dozen years, we've actually seen companies harvest their existing operations rather than build new ones. They haven't reinvested back in exploration and development. So we've actually seen gold reserves held by mining companies go down 40% since their peak about 7 years ago. So we are not equipped as an industry to respond to higher gold prices, to provide that additional supply. And so the supply is a strong fundamental indicator of the direction the gold is going. It's scarce, it's becoming increasingly scarce, and demand is only going to go up as fiat currencies continue to be printed.
So how do you see the price of gold going forward?
My call has been for $3,000 an ounce, and in this cycle at a minimum. And just to reassure you that I didn't pull that out of my hat, I looked at the previous all-time high for gold, and that was $850 an ounce in 1981, when we were undergoing a very similar dynamic in the economy. We had hyperinflation. That at the time was being driven by oil prices and what it did to infect the supply chain, because oil ran everything in our economy back then, still does to a large degree, and that drove dramatic inflation. And gold peaked out at 850 before Paul Volcker took over the Federal Reserve and tamed inflation with much, much higher interest rates. We're not anywhere near that point right now in terms of interest rates going up or money supply being curtailed at all. I think it's lower for longer in interest rates. And so this is a different type of inflation. It's being driven by money printing and not higher oil prices. Energy prices have been largely tame, maybe slightly higher recently, but I would say this is just being driven by the fact there's more paper chasing fewer hard assets.
So for the next gold rush, would you rather be a gold prospector looking for and mining gold, the guy who sold the prospector a shovel, or the guy who provided cash to the prospector to buy the shovel in exchange for a percentage of all the gold he ever finds?
Well, clearly at this end of the cycle, or this point of the cycle, I would say the latter, which is why I'm running a royalty vehicle right now. And the dynamic behind that, after 30 years of running operating businesses, building mines and operating them, I've come to the realization that even though the gold price is going to be going up dramatically, I also think that input costs will inflate dramatically in the mining business. And the reason I think that is because of the significant amount of underinvestment that's occurred in the mining industry in the last half a dozen years or so, the decline in reserves, the decline in production. And that's not only true for the gold industry, it's true for the base metal industry. And demand is robust for things like copper as we decarbonize the economy and whatnot. But guess what? Copper companies, gold companies, they use the same engineers, the same geologists, the same equipment, the same plants. They need all of the things, they need all of the same things to build out their mines. So there's going to be a flood of capital going in to new mine construction over the next little while. Against the backdrop of inflation in the general economy, I think that means significant cost inflation. So I want to be part of the royalty business for two reasons. One, to insulate my shareholders from that cost inflation while participating in the gold price upside, but also because royalty companies are an important part of the ecosystem to help finance new mine construction and development and exploration. We provide capital much more cost effectively to the producers and developers than they can otherwise access themselves in the general equity markets. It's a challenge for them. royalty companies trade at a higher multiple because of their lower risk profile. They provide leverage to the gold price, leverage to exploration success, but they're insulated from costs because it's all top line exposure. You get a percentage of the revenue, typically 1, 2, 3% of the revenue from the mine. So the gold price goes up, our royalties go up. If they find more ounces in the ground at that mine, guess what? Our royalties adhere to that as well. We get the exploration upside. And so that's the beauty of this model. And I'd say, particularly at this point of the cycle, this is where I want to be after over 30 years of building and operating mines.
So you are now the CEO and chairman of Gold Royalty Company. Can you provide some background about your company?
Well, it's interesting. It's a very similar model to the one pursued by Wheaton Precious Metals 15 years ago, which was spun out by my old company, Gold Corp. For those of you that don't know Gold Corp, I ran it and merged it with Newmont back in 2019 in a $32 billion merger, the biggest gold merger ever to occur in the business, to create the world's biggest gold company by market cap and production. And so coming out of that, I looked for opportunities to create a royalty vehicle. And one of them I came upon was Gold Mining Inc. Gold Mining Inc. owned 12 development stage assets, which we think will be quite attractive to producers that are looking for scarce project opportunities. And we were royalties on each of those dozen projects, 17 royalties in it all. And then we created a royalty vehicle that we IPO'd back in March and raised $90 million US. We used our currency on the NYSE to then acquire one of our competitors, Ely Gold, a royalty company with many of their royalty opportunities in Nevada and also in Quebec, as it turns out. And we expanded our royalty portfolio from 17 to 110 as a result of that acquisition. And then most recently, we announced a three-way merger with Golden Valley and Abitibi Royalties, which will bring our royalty count to almost 200 royalties with a significant focus on Nevada and Quebec again. And so what we created now is a vehicle that will have a pro forma market cap of close to $800 million from a standing start a year ago, with almost 200 royalties, with 3/4 of our royalty portfolio in the two best jurisdictions in the world, in Quebec and Nevada, as judged by the Fraser Institute here in Canada for mineral potential, low regulatory risk, and low political risk.
In the movie The Shawshank Redemption, it was not initially praised, but grew over time to be an audience favorite. I read that the actor who played the warden, that 10 years after the movie's release, he was still getting around $100,000 residual check each and every year. So does your company have projects kind of equal in size to each other, or do you have that one outstanding Shawshank Redemption type project?
Well, we have both, and the three-way merger with Golden Valley and Abitibi actually brings us an asset called Canadian Malartic and a royalty thereon in northwestern Quebec. My old haunting ground. I was the CFO at Agnico Eagle for 12 years and helped build 3 mines in the same district within about 30 miles of Canadian Malartic. So Canadian Malartic is Canada's biggest producing gold mine. Produces about 700,000 ounces a year from an open pit. This is our Gold Strike. As Gold Strike built Franco-Nevada, this will provide the foundation for our company and be paying royalties for 30, 40, 50 years. Who knows? They've only been mining from open pit up to this point, but their operators, my old company, Agnico Eagle and Yamana, are investing $1.6 billion in a new underground mine there. Right now, they're already sinking a shaft, which will open up deeper horizons for exploration and ultimately, I think, will balloon the size of this deposit and perpetuate its life for many, many decades to come.
Looking at this pie chart of the different projects in your pipeline, how can you describe sort of the near-term and long-term outlook and the types of projects you take on?
Well, look, we have projects across the entire value creation spectrum in the mining business. From early stage exploration, we have royalties, to things in production. We have 6 in production currently, 7 in construction, which means that we'll see a 5-fold increase in our cash flow within the next 3 to 5 years as these construction projects achieve commercial production. And we have loads of optionality in the early stages of our pipeline. And we continue to generate new royalty opportunities organically. We have a team in Nevada. We have a team in Quebec that focus exclusively on staking exploration claims, farming the properties out to the explorers and operators to spend money on them and taking a royalty back in return. That's an extremely cheap way to create a royalty. without actually having to put any money in the ground whatsoever or take any of the exploration or operating risk. We leave that to the operators and explorers to take on.
There's an old story about a contractor building a home for a future owner. The home builder says, I have good news and bad news. And then what's the bad news? Well, the budget's all spent. So what's the good news? We're halfway done. So if you need a producing mine at the end of your investment, how do you protect your investment?
Well, that's the beauty of the royalty model is if there's a cost overrun, we're not subject to that. We're insulated entirely from that. That's really up to the operator to find sources of capital. In fact, that might present another opportunity for us because maybe then we slap another royalty onto the property and provide them additional capital. That's the beauty of it, but we're not subject to cost inflation. We're completely insulated from that. So we put our capital in up front to help them fund the construction development. We take a royalty back, and that royalty is there for forever. It doesn't go away. It's adhered to the property permanently, even survives things like bankruptcy. An operator can go bankrupt, but the royalty stays on the property in perpetuity.
Where do you fit in the gold royalty world, sir?
Well, right now there's been a proliferation of royalty companies in that kind of sub $1 billion market cap category. But unfortunately, many of them are zombie companies because they have low liquidity. They're unable to access capital. So they really can't grow their business beyond what they have in their, legacy or foundational portfolio. And what we're trying to do is achieve scale quickly because for us to be effective financiers, we have to have access to capital more cheaply than the mine producers. The best way to achieve that is through scale. And so we've scaled up quickly. We scaled with our IPO, raising $90 million. We scaled up with the acquisition of Ely, going from $200 to $400 million market cap. And then we rescaled again with the three-way merger with Abitibi and Golden Valley to doubling again to $800 million. That scale is important to ensure that you have an adequate weighting on the passive indices like the GDXJ, which we graduated to in May of this year. And that weighting means more passive buying, a higher multiple, lower cost of capital. It really creates a bit of a virtuous cycle. The lower our cost of capital, the more we can access it and put it to work in new royalty opportunities, which makes us bigger, again, lowers our cost of capital. And that cycle goes on and on and on. And that's how you perpetuate and grow the business and create a lot of value on a per share basis for your shareholders.
What is being listed on the New York Stock Exchange and being included in a gold mining ETF say about your company?
Well, it's access to the deepest capital pools in the world in the United States. There's no doubt about it. And every company I've ever been involved with, and I've helped build 4 multi-billion-dollar companies in my career, have been listed in New York. Having that U.S. access allows us to access deep capital pools with a good fundamental understanding of our industry and the value proposition in our industry.
I'm going to put a link in the description to your company's website where a presentation would be available. Is there anything else you'd like to add?
No, listen, if you want to learn more about us, please visit our website, goldroyalty.com. We're GROY or GROY on the New York Stock Exchange as well. So multiple portals for you to get to know our company a bit better.
Mr. Garofalo, it's been great talking with you. Thank you for your time.
Thanks, Rob.